So good morning, everybody. Welcome to PK Wealth's inaugural webinar. We will be discussing themes, trends, and portfolio positioning in an uncertain world. My name is Sim Downs. I'm the Business Development Manager at PK Group, and we have two keynote speakers, Graham Frost, the Chief Investment Officer at PK Wealth, and Michael Usher, the Investment Director at PK Wealth. First presenter will be Graham, who will be discussing the impact of COVID-19 on investment markets. And following that, Michael will take over and talk about PK Wealth's portfolio positioning and the strategy going into the future. So without further ado, I will hand you over to Graham, and I will move on to Graham's first slide.
Thanks, Sim, and welcome everyone. I'll give a brief overview of the current state of play in financial markets in relation to COVID-19. So far, we've had over 2.6 million infections, 700,000 recoveries, 1.7 million people are currently infected, and we've had over 180,000 deaths. Over 200 countries are now infected. There were three things we needed to see for stock market and bond markets to recover from the March lows. The first was successful containment. That's infections rolling over. And you need widespread testing. No testing, and you end up like the UK with recorded infections, just people sick enough to go to hospital. Sim, you could put up the second slide, I think, on the rollover effect. No idea what the number of people are actually infected until mass testing is done, and that will take months. But on this slide, you can see certainly a slowdown and a plateauing, if not a rollover, in infections. Still, lockdowns are working as new infections seem to be getting less. The World Health Organization estimates that 3% of populations may have been infected. So we can forget about herd immunity, and you don't need many infectious people to restart the epidemic. And that only changes, of course, if a vaccine is available, and that's at least 1 year away. So are we in lockdown until then? And our answer is no. The fact is that the economic damage is simply too much to bear. On the next slide, we'll see a forecast from an economic research firm that we subscribe to, Capital Economics. It's independent. I'd say it's probably slightly worse than the average. So there are plenty of more optimistic or pessimistic ones available, but I think this is probably the most realistic. You can see moving from left to right along any line that the economic impact, these are shrinkages in GDP, quarter on quarter in the first four boxes. It's really, really severe. But you can see in the third and fourth quarters that as lockdowns are released, economic activity bounces back. Nevertheless, when we look to 2020 column, the year-on-year numbers, so this year over 2019, still major economic contractions everywhere. I think the only number I would probably take exception to on this forecast is a Chinese number. -5% for China seems to be a little severe. But nevertheless, you're looking at a world economic contraction of 4.5% on this forecast. This is the biggest contraction since the Second World War. But at least we can see a sustained and a fairly robust recovery. That doesn't mean we get back to trend growth rates very quickly then. And without government and bank intervention, this could have developed into another Great Depression. And that brings us on to the next thing that we needed to see before we could see a way out of this mess. The first thing is monetary easing from central banks. And this is primarily cutting interest rates to the bone and printing money also known as quantitative easing. Interest rates are now near zero in the US and UK, and they're negative in Japan and Europe. In fact, they were negative even before this crisis started in those countries. The central banks print money to prevent rates rising across bond markets and provide liquidity for debt markets that froze in panic in early March. And the US Fed is for the first time in history buying corporate debt and high yield debt or junk bond debt. It's made over $2 trillion available for that purpose. And the idea is to allow businesses to keep borrowing at low rates until the virus abates. Central banks also buy government debt, so governments can borrow at zero cost. There appears to be no limit to further bank action if required. And that brings us to the third thing we needed to see. That's government support for consumers and businesses whose income stopped during lockdown. And this slide that's on the screen now shows that they needed support very badly. Governments essentially needed to issue trillions of dollars of debt to pay business to keep them employed or pay unemployment benefits if they've been laid off. You'll have seen newspaper headlines of 22 million people signing up for unemployment benefits in the US, probably up to about 2 million now in the UK. And just the US government has a stimulus package of now up to 2.5 trillion. That is over 10% of GDP. And this slide takes into account even all these stimulus measures. So all governments are doing, essentially, is trying to preserve the economy, put it into deep freeze, so that when it comes out, it can thaw out and get back to business. So the US stimulus package of $2.5 trillion can in fact be doubled through the banking system, through their gearing, for 20% of GDP, which is about the level of economic contraction that we're seeing over a couple of quarters. And that's repeated, of course, in the UK, Japan, Europe, and around the world. And they're still being added to. Again, governments appear willing to do whatever it takes, so we can expect even more if necessary. I should say here that the collapse in the oil price, which is usually a boost to consumers and business, hasn't helped in a lockdown. In fact, it's pushing US shale producers into bankruptcy, and that's a massive industry in the US. It also increases pressure on oil exporters, particularly in the emerging world. So we have our three needed conditions for making risk assets more attractive. Risks remain, not least business defaults or bankruptcies, and a return of the virus in the future. We think that the latter will make governments cautious in relaxing lockdowns, so we actually don't expect a meteoric rise in activity in the short term. My personal view is that governments will be tolerant of a certain level of infections that their health services can handle until a vaccine is found or viral drugs become effective. That means there's going to be some interesting political decisions made in future regarding rates of allowable infections and deaths. And now obviously during this, short-term profits for business was going to be hit badly this year. And across regions, estimates are between 25 to 40% earnings losses. And dividends will follow. In fact, dividends will be even in bigger contraction because central governments have really not allowed a lot of businesses like banks to pay out dividends, even if they can, preferring to be cautious and to preserve liquidity in the system. So there will be a big recovery next year, we think, but not to previous levels for a while, and firms will have more debt to pay off. So in summary, we think the recovery is going to be bumpy and subject to infection outbreaks. Markets will, in our opinion, shift now to focusing on exit strategies from the lockdowns and exactly how long they will take. And that may see further volatility in markets. I'll pass you back to Sim now.
Thank you very much, Graham, for your insights. And before we pass on to the next speaker, Michael Usher, I just wanted to say, if you want to ask any questions throughout the presentations, feel free to do so using the chat functionality. If you select the chat option, and then you can select PK Group, it should be automatically selected, and we'll send a message to myself. And then we have an opportunity for some Q&A after the presentations are over. So now I'll pass you on to Michael Usher, who will talk about portfolio positioning for the PK Wealth portfolios, and we'll go into more detail.
Okay, thanks, Sim, and good morning, everyone. Thanks very much for attending. And thanks also, Graham, for setting out the background there. Obviously, some major challenges ahead. So really just sort of starting off by saying, you know, how did we sort of enter this downturn? We generally, for those of you who have portfolios with PK Wealth, casting minds back, acknowledge that we were operating at the lower end of our asset allocation ranges and also the lower end of our volatility ranges, mindful that equity markets were priced at quite high levels during the course of last year and the early part of this year. Other risk factors that we generally take account of in portfolios: market capitalization, size of companies. We've got a range within portfolios of large, medium and small companies. Clearly smaller companies have been affected to a greater degree, although given the proportions that we were holding in a portfolio, it hasn't disproportionately impacted performance. Liquidity constraints, also a key factor within portfolios. Clearly when we're selecting underlying holdings, we're looking at size of funds, underlying style, actual underlying holdings, whether funds have been gated before. In that example, we haven't held any direct property funds within the portfolio, a number of which have been gated. And we're also looking at liquidity, liquidity constraints incorporated. Levels of gearing. We hold generally two types of asset within the portfolio: open-ended funds, which are unit trust, or open-ended investment companies, which generally have lower levels of gearing. They're restricted in the amounts of gearing that they can have, up to about 5%, generally for liquidity purposes. And investment trusts as well. We hold two in the portfolio which can hold high levels of gearing, but the two that we hold have got low levels. So we've managed to sort of contain risk across the portfolios using all of those metrics. So as to the future, given that we were exercising a level of caution on the way in, we were always looking to acquire equities and add to equity in portfolios at low valuation levels. So just going on to the next slide, we now have clearly the ability to do that, and in fact have already started the process. So we're increasing exposure to both fixed income and equity in low risk portfolios, and that's cautious and cautious to balanced. There are opportunities in fixed income, as Graham mentioned earlier on. Fed are applying massive support for high yield debt in the US, which presents opportunities. And we're also adding to equity in those portfolios and in high risk portfolios balanced to speculative. We're doing that really because the longer term expectations for equity markets, for returns from equity markets have improved from low levels of valuation. Obviously, we're uncertain as to when those opportunities are going to come through. So timing is key. Clearly, we don't want to overcommit to equity markets at the moment, given uncertainty. So we're looking to drip feed into equity markets. As I say, we've already started that process. In fact, we've rebalanced portfolios 3 times so far. Once in early March, around about sort of FTSE level of 6,500. Mid-March, FTSE level about 5,200. And we're just in the process of doing another one at the moment. FTSE levels around about 5,700. So in total, that's adding to a balanced portfolio an additional equity weighting of 6%. On existing assets, clearly we're keeping those under review and are making some changes along the way. We've sold one holding in Fidelity American Special Situations and replaced with Artemis US Select, which we think is better placed for the next 2 to 3 year period. So going on to the next slide, just putting some numbers on that, and perhaps just focusing on the balanced column in the middle. Long-term asset allocation to equity at 57%. Currently, allowing for the rebalance that we're doing at the moment, we're sitting at 56.5% exposure to equity. And that's come up from a low during the course of last year of 51.5%. So it's not a straight line 6% increase because portfolios have been going up and down in value, but there has been a net 60% increase in allocation to equity. And that's mainly coming from a reduction to other assets and also a reduction in cash. Going forward, the additional equity allocation that we're looking to make, pushing 56.5 in that example up to probably early 60s, would come again from other assets as well as fixed income. We're looking to do this across the board in proportion, so put up the cautious to balanced risk profile there and balance the speculative, and we're applying the same logic, increasing equity allocations up to long term and then beyond. Going on to the next slide, just a perspective on performance. And these performance numbers are really in the context of having been at lower end of asset allocation ranges and volatility ranges over the last 18 months. So you can see that longer term performance, despite that, from inception on the right hand side of the page, it's still competitive versus these are investment association indices, so they're representing peer group. There's never a perfect set of indices to compare against, so there are variations and anomalies across all of these. But risk is one of the things that brings it together, where if you look on the left-hand side of the page, the 3-year volatility numbers, there's some consistency between those numbers, between the IA returns and also our own. The 12-month numbers were a little bit lower on comparison to the 12-month numbers, again, because the risk that we were carrying, the lower risk that we were carrying is reflected there, i.e. we haven't bounced quite as strongly in the last couple of months. But over the quarter 2020 Q1, we're now starting to move more in line, and that is reflective of the additional equity that we have added in portfolios during that period. So that tells us that our strategy for adding equity is correct. We will continue that process, as I mentioned, over the next 2 to 3 months. So therefore, we expect to move into a period of outperformance. So performance improving relatively over that period, assisted clearly by the addition of equity. So we expect our long-term numbers, assuming that we do see a way out of this over the next 2 to 3 years, then we expect our performance numbers to start moving ahead of peer group. The bottom there, I've just put the FTSE 100 in as an indicator. You can see that the long-term returns have been pretty lackluster. Q1 2020 pretty lackluster as well, and all from quite a high level of risk. Over on the left-hand side of the screen, the 13.9% number is a standard deviation number, which I won't go into the detail of that, but it's a number which reflects risk which has been carried in different investments. And you can see that if you equate the return of 7.1% over the last 4 years to the 6.74% at the top of the page from our cautious risk profile, a similar level of return with a risk level of 5.3, not far off a third of the FTSE 100. So similar level of return for a third of the level of risk. And then just going on to the final slide. what I've done here is just put up a comparison against a number of investment companies that we track on a monthly basis. And so got our cautious to balanced portfolio and balanced portfolio represented here. So you can see that the cautious to balanced portfolio can put the standard deviation numbers in on the right-hand side. That's the lowest standard deviation number on the page, so the lowest risk on the page, and one of the highest performance. So really pleased with the relative performance of that portfolio. Balanced portfolio carry a little bit more risk, so a reasonable representation from that. Other interesting things on the page: Schroeder diversity income near the bottom, carrying quite a low-ish on a relative basis level of risk, but a low return. So we're just aware of the strategy that it's normally to do with types of underlying holdings, exposure to different geographic areas, those sorts of differentials that throw up these inconsistencies. So in summary, a pretty respectable return amongst the peer group, and well positioned for future outperformance.
Thank you very much, Michael. Much appreciated. We now going into the Q&A. So if you have any questions, please feel free to ask them via the chat. There've been a couple of questions come in first off. So if I dive in here, and then you guys can take them. First question is: will Brexit worsen the situation, or have you factored that into your strategy?
Perhaps I can talk. Perhaps I can talk to that first. Michael can chip in. I think Brexit is definitely built into the markets, and therefore is built into our consideration. There's no doubt that the UK market, apart from its higher weighting to oil stocks, which I mentioned earlier, taking some damage, and banks, which have also taken some damage in this sector. But the market is generally being weaker than other markets, and the sterling has generally been weaker than other currencies. And that's simply because there has been no resolution to the Brexit negotiations. Some of them have been cancelled. They are ongoing now. It was always a big ask to have an exit date written in stone for the 31st of December this year. And I think that's reflected in market valuations.
Yeah, I think the only thing I would add is that I think the UK economic numbers are looking a little bit weaker as a result of that. I don't know whether it sort of levels the playing field a little bit more for the UK going forward. The last Boris mentioned on the subject was that despite what's going on at the moment, he's still seeking to exit on the 31st of December. So yeah, I think certainly the UK's economic trajectory will be slightly impaired and take slightly longer as a result.
Yeah, I think, but just at the portfolio level, I think it's important to note that we've actually been reducing our UK exposure in favour of other markets, primarily the US.
Okay, thank you, guys. Second question: how will the current climate affect cash positions in the medium term?
Well, we've been reducing cash positions. Part of the new acquisitions in fixed income, low risk portfolios, and equity, lower and high risk portfolios. Part of that's come from cash. Part of it's come from alternatives, and increased allocations further down the line will come from fixed income. So having held higher cash allocations during the last 18 months, we are drip feeding back in.
Yeah, I think one thing that all investors should bear in mind is that interest rates are now at zero again, and likely to stay at very low levels for the foreseeable future. So the old chestnut of, well, what do you do with your money comes back into fashion. And that's one of the reasons why markets have, despite drastic economic numbers, have rallied.
Okay, great. I mean, that leads on to another question, which you've touched across. What would be the best scenario for your, equity markets have seen significant gains in recent weeks. And what does this mean for valuations? And are these gains sustainable?
Should I come in there again? Yes, I think I've no doubt that markets would be down a lot more. I mean, I think on average they fell, say, 30% in the first quarter. The great financial crash, they were down 50% over an extended period of time. So this is all being concertinaed into a very short period of time. I'll say I'm surprised that the markets have rallied so strongly given the level of uncertainty. And that's mostly down to the markets maybe more hopeful that the virus was rolling over in terms of infection rates, but primarily because of this massive support, which is just completely unprecedented, much higher and much quicker than the great financial crash of 2008-9. So with that type of support, there's a saying in stock markets, don't fight the Fed, meaning the Federal Reserve in the US. If a central bank can print money to its heart's content indefinitely, it does tend to support risk assets. Having said that, as I said, I've been surprised about the strength of the bounce. It wouldn't surprise me to see another leg down. And in fact, as long-term investors, we don't get scared of that. In fact, we welcome it because it gives us a chance to buy cheaper assets and make better returns for you over the longer term.
Yeah, just putting a couple of numbers on that. The G4 central bank bond purchases during a sort of 4-week rolling period during the height of the GFC, the global financial crisis, they were running bond purchases at about 200 billion, whereas the US central bank this time round are running those same purchases at 1.2 trillion. Which is vast compared to the financial crisis. And I think I'd reiterate some of the things that Graham has just said there. I think that support is absolutely key for where markets are at the moment. And clearly markets are overlooking all of the negative numbers on the chart that we were looking at earlier on for this year, the negative economic numbers, and are looking, exclusively at all of the positive numbers that are coming through for 2021. So ongoing bank support, clearly any secondary impact from the coronavirus is also a touch point. There have been a couple of reports that have come through. I mean, Singapore was certainly mentioned this morning. I mean, hopefully, relevant countries are better able to contain any secondary emergence, but that is certainly something that would impact stock markets as well. But valuations are difficult and imprecise at the moment. The unemployment data is probably the key numbers to watch at the moment. We know in the UK that around about 27% of staff employed staff have been furloughed, only 1% made redundant. So those statistics are probably the more important at the moment, given that there are anomalies in the US statistics, with over 20 million people unemployed. There are some specifics to do with that number. But as long as those unemployment numbers stay relatively low, that is a positive sign for later this year and into 2021.
Okay, thank you very much. So I think we have time for one more quick question. The Chancellor has set out the rescue package to help us through current circumstances, but where is the money coming from? Is it from printing new monies, raising debt, or somewhere else?
Well, the simple answer to that is both. The central bank, and this is probably the first time that we've seen a sort of new economic paradigm, which I personally find a bit odd. The central bank is essentially printing money to buy bonds from the government when they raise debt at close to zero interest rates. In fact, because of the way the Bank of England is structured this with the UK Treasury, they rebate the interest on the bonds back to the Treasury. So in effect, the government's getting paid to borrow. The UK, I think, has announced a sort of 330 billion package. Again, stand open to correction on that. They're adding to it all the time. That's a massive number if you look at the average, 10 times the average UK deficit for the last few years. But a lot of that is in the form of guarantees. It's similar in other countries. You could probably take a rough number at about 60% of that is in the form of guarantees, and hopefully nobody actually gets paid out. But anyway, to finance it, whatever the number is in the end, the government issues debt, the central bank prints money and buys it. It's as simple as that. The reason I find it somewhat odd is that it opens up a host of issues in future regarding inflationary consequences from this. My own opinion is that a lot of that debt, whatever the number is eventually, will just be kept on the central bank balance sheet and never paid off.
Thank you very much, Graham. I think we're going to wrap it up there. I think we're going to run out of time. So thank you very much for attending, and thank you to our keynote speakers, Graham Frost and Michael Usher. If you have any questions, please feel free to email me and us at investments@pkgroup.co.uk. Thank you very much, and goodbye.